Welcome to Dividends Demystified, how to make money while you sleep. In the world of investing, dividends stand out as a powerful tool for generating passive income. Today we'll explore the ins and outs of dividends, how they work, and why they can be a crucial component of your investment strategy. Dividends are regular payments made by companies to their shareholders, typically distributed from the company's profits. These payments serve as a reward for investors who hold shares in the company, providing a steady stream of income without the need to sell their stocks. The concept of dividends dates back to the early days of stock markets, with the Dutch East India Company being one of the first to pay regular dividends in the 17th century. Since then, dividends have become a fundamental aspect of investing, particularly for those seeking long-term wealth accumulation and income generation. But how exactly do dividends work? When a company generates profits, its board of directors decides how to allocate those earnings. They may choose to reinvest the money back into the business, pay off debt, or distribute a portion to shareholders in the form of dividends. The amount of the dividend is usually expressed as a fixed sum per share or as a percentage of the stock's current market price, known as the dividend yield. Dividends are typically paid on a quarterly basis, although some companies opt for monthly or annual distributions. The frequency and amount of dividends can vary depending on the company's financial health, industry norms, and overall economic conditions. One of the most appealing aspects of dividend investing is the potential for compound growth. By reinvesting your dividends to purchase additional shares, you can accelerate the growth of your investment over time. This strategy, known as dividend reinvestment, allows you to harness the power of compounding, potentially leading to significant long-term returns. It's important to note that not all companies pay dividends. Growth-oriented companies, particularly in the technology sector, often prefer to reinvest their profits to fuel expansion rather than distribute them to shareholders. On the other hand, more established companies in sectors such as utilities, consumer goods, and real estate are known for their consistent dividend payments. When considering dividend-paying stocks, investors often look at the dividend yield as a key metric. The dividend yield is calculated by dividing the annual dividend payment by the current stock price. A higher yield may seem attractive, but it's crucial to assess the sustainability of the dividend payout. Companies with exceptionally high yields may be at risk of cutting their dividends if their financial situation deteriorates. Another important factor to consider is the company's dividend payout ratio, which measures the percentage of earnings paid out as dividends. A sustainable payout ratio typically falls between 30% and 60%, although this can vary by industry. A ratio that's too high may indicate that the company is returning too much of its profits to shareholders, potentially at the expense of future growth or financial stability. Dividend investing isn't without its risks. Companies can reduce or eliminate their dividends during challenging economic times or if they face financial difficulties. Additionally, dividend-paying stocks may offer lower potential for capital appreciation compared to growth stocks. Therefore, it's essential to maintain a balanced portfolio that aligns with your financial goals and risk tolerance. For those interested in dividend investing, there are several strategies to consider. One approach is to focus on companies with a history of consistent dividend growth, often referred to as dividend aristocrats. These are companies that have increased their dividends for at least 25 consecutive years, demonstrating a commitment to shareholder returns and financial stability. Another strategy is to invest in dividend-focused exchange-traded funds or mutual funds. These investment vehicles provide exposure to a diversified portfolio of dividend-paying stocks, reducing the risk associated with individual stock selection. As we conclude our exploration of dividends, it's clear that they offer a compelling way to generate passive income and build long-term wealth. By carefully selecting dividend-paying stocks or funds, reinvesting dividends, and maintaining a diversified portfolio, investors can potentially create a reliable income stream that grows over time. Remember, while dividends can indeed help you make money while you sleep, successful investing requires diligence, research, and a long-term perspective. As with any investment strategy, it's advisable to consult with a financial professional to determine the best approach for your individual circumstances. Thank you for joining us on this journey to demystify dividends. May your investments prosper and your passive income flow abundantly. For more learnings, subscribe to the channel.